So that was Prime Minister Modi talking at NASSCOM with the leaders of technology, various companies listed and unlisted, and the luminaries of the IT industry. Mr. Ganeshram is waiting by very patiently to chat with us about his latest report. Ganeshram, let's start by understanding your thoughts on technology. Prime Minister Modi was also talking about how technology can be leveraged to implement various government schemes, etc. And technology as a space has outperformed lately, be it COVID-led push or general, growth coming back, margin expansion, etc. What are your thoughts on the entire technology space, in the listed side? How are you looking at this area?
Good afternoon, Ajay. Good speaking to you. We believe that IT sector is a sector. We need to be a little cautious on that. We have been underweight on that space. Our portfolio bias is decisively tilted towards domestic cyclical recovery. IT sector, we are still a little cautious on the street's expectations of earnings next year. Right? It's a combination of both. The streets expecting both demand recovery, pricing to be strong, and margins, all the cost benefits to sustain. So the margin assumptions, the profit growth, earnings assumptions, we think are a little too optimistic. We believe that it will be either demand or margins, not demand and margins. So we are quite decisively lesser than consensus on expectations going into the next 12-18 months. In the shorter term, they think the street is more right than us, but we are looking at beyond the horizon, and we think with that in mind, our caution actually we think will pay heed as we go into the second half of 21 into 22.
Right. Ganeshram, I was looking at the model portfolio and your strategy report. Clearly domestic cyclicals, which you like, financials out of them, big ones, and mid-cycle ones, names like LIC Housing, vehicle finances, M&M, etc., corporate banks and retail bank. You have a good basket out there. Which, in your view, in this entire basket, which category is better placed in the kind of asset quality reversals or easing out which lie ahead and improve growth as credit improves in the system? The credit uptake happens as the economy comes out.
See, I think we are playing both, as you rightly pointed out. The bias is definitely towards loan books which have a corporate bias tilt, especially if those corporate assets would have seen stress build up over the last many years. We think corporate balance sheets have materially deleveraged. The pain is materially reduced, and we think inflation in the form of commodity prices will lead to working capital demand reviving, which means credit growth should pick up as you go into next year. The banking sector has also got consolidated. We are seeing virtually 6 banks driving 70% of the growth, which means to that extent, interest rates, there will be some amount of calibration on how much interest rates gets passed on to the end consumer, which basically means margins will be quite stable. So a combination of credit growth recovery, stable net interest margins, improving asset quality, which is a combination of both corporate NPAs being a lot less, COVID provisions, which we think are in more than what even our worst case scenarios are, which means return on assets will expand for banks. The ones with the maximum uptick or delta is ones we are preferring more. They were the ones who were impacted more, and those stocks got impacted more. So to that extent, our preference is banks which were impacted a lot more in the corporate stress will be our preferred basket. Of course, we also are positive on how real estate cycle will recover. And real estate has various parts to it: developers, financiers, building materials companies, and consumer durables and the like. So within housing finance companies, the list is not too long, but we have gone for some of them to play how we think So it's a very bottom up understanding of the company, the management, and which is preferable, where management stability can be better perceived for us. So we have gone for one or two names which are real estate proxies as well in the way we are evaluating and building our financials portfolio. But overall financials overweight stance. This is something that we have been having now for almost 11 months, pretty much from late March when the stocks corrected heavily. Till now, we have continued that stance. It was heavily contrarian back then. Today, it's more widely accepted and it's in line with how market sees it. But we have held on to it through the thick and thin.
Right. Ganeshram, how are you really playing this cyclical theme via the manufacturing side? PLI beneficiaries, deep cyclicals like capital goods. How do you like that space, and how can that participate in the cyclical recovery in your view?
See, there are two pockets of manufacturing that we are very positive on. One is the whole electronics space, which we think is a multi-year big theme emerging in India. And not only the companies which manufacture electronics, but also the whole supply chain around them. The second is pharmaceuticals, where we think there can be a potential impact which can come due to the PLI sector. Apart from these two, we need to wait and watch which other sector can be material beneficiaries. Autos, something which is being spoken, we still want to watch out which ones can benefit most. But for us, how we are playing the whole industrials recovery is a combination of now, see, till maybe about 2 months back, even a month back, our confidence on government spend as a big theme was not as strong. We did see beginning November, government had started spending on infra, but we were not very confident of how that will take shape in fiscal 22 and beyond. The budget has given us more confidence in terms of how government spend will be a tailwind. So we have added one infrastructure stock into our model portfolio, a large construction company, which also benefits when there is large government infra spend. But till a month back, our preference within the cyclicals pack was on cement, building materials, or even companies which were oriented to real estate capex or automobile. So basically waiting on household capital expenditure, which has been our whole bet. So the reasoning behind that is, see, we are basically chasing the money. If you sit back and watch in the last, say, pretty much calendar 19 and during the pandemic, where has the money gone? And if you look at that, tax collections have suffered, which means government has lost a lot of tax revenues. Corporate top line has got impacted. But where has money gone? If you evaluate it, forex reserves have jumped. It's gone up by last year $120 billion, and even the previous year it had gone up about $40 billion. So where has this money gone? It's gone into households' bank accounts. So if you study the savings bank balances of banks, it's materially jumped up. And which means as interest rates come down, we think the next phase of spend will be driven by household capital expenditure. It is in the form of real estate, in the form of consumer durables, automobiles. So our preferred cyclical beneficiaries are in that pack. Direct and indirect beneficiaries are in that pack. Banks will be inherent beneficiaries of this. So, they are a broader reflection of all these. So it's banks, automobiles, consumer durables, cement, real estate developers, and a whole ancillary space around them, including discretionary consumption, which are in some form built in all of these. Where we are cautious are, as I told you, IT. Second is life insurance. Third is consumer staples, which are extremely overvalued, and nothing wrong with the companies, and they will continue to show their early teens or maybe late single digit top line growth and maybe even EBITDA growth. Earnings growth might be a little more, but valuations are so expensive that we think outsized return potential is unlikely. So we have been cautious on staples now through this last 9 months. 9-10 months, and our incremental weights are more in the cyclical sector. We have also been cautious on oil and gas, so that kind of stays. Another aspect on industrials which you asked, the whole private sector capital expenditure proxies, we still think that's at least 18 to 24 months away. We've seen government spend pick up, and as household capex picks up, that should lead to more capacity utilization. That should eventually lead to capex. So that space is again something which we are kind of avoiding.
All right, Ganeshram, we'll let you go on that one. Thanks so much for joining us on the show today. With that, let's take a short break. On the other side of the break, we'll get you more stocks with quick news and analysis. Don't go anywhere.